Welcome to the midweek market update at Wealthy Bucket. The midweek update is produced to gauge and analyze how the markets have performed and how to prepare for the last few days of the trading week. Wealthy Bucket does not provide investment advice. Please consult a financial professional before investing in the markets to see if it is right for you. Trading and investing in stocks, options, currency, and futures carry risks that can result in a financial loss. So let's kick it off with some headline news that we are expecting tomorrow morning from the ECB, or the European Central Bank. Now, there are forecasts that the ECB will be cutting rates tomorrow, and then there is the buzz that they're not. And when the buzz says that they're not, it has a pullback on European markets, as you can see through the German index this week. So how to play this out? You can see here for the first 3 days of the trading week, Monday, Tuesday, and Wednesday, and now we're looking at Thursday overseas in Asia right now. So Monday, Tuesday, Wednesday, the level that was identified has completely been respected. You can see it's not trading, it's not closing above it, it's not closing below it, it's just hanging around, and you know you have a great level when price is respecting it, and it's almost to the cent, so to speak, from a daily open and a daily close perspective. You know you got the range accurate, and you have a very, very well thought out and timed market, so to speak. Now, the play is if the ECB actually does cut rates, we can expect the euro to head down here very, very quickly. If it does not, we're expecting a rally. Now, we actually, based on our most recent Bucket Weekly, we had anticipated that the euro will actually travel upwards in anticipation of possibly not cutting the rates, or traders simply just bringing the price up and waiting for the news to come out that they're going to cut it, and we expected the short to happen. And that was one of our Moneyflow ideas, and obviously it hasn't kicked in, and it might not kick in, because if the ECB doesn't cut rates, we could see an escalating euro, and that's one of the reasons why we haven't been using the euro as one of our indicators, simply because the correlations aren't reliable to the equity market, so to speak. It's just not moving. So that's what we're going to look at tomorrow morning. We have a German ETF still on the go, so we're going to have to watch out and monitor that. If they don't cut rates, we could see further pullback this week in the German markets. That's what we want to look out for going into going into tomorrow, and see how it performs on the last trading day of the week, which is going to be Friday. So let's move ahead now to the S&P. Now we had raised our immediate support to 1888 and 1901 last Sunday, and you can see here that the S&P still has not retraced. You can see that there's a lot of support for the index when you have these tails or shadows or whatever people want to call them. You can see that when price comes down, there are traders or there's programs buying it back up, and that's what causes these shadows or tails or whatever you want to call them. So we're still seeing support for that. We're seeing a normalizing market, so to speak, because price, when it moves up, generally in a normal market, it doesn't shoot up, it doesn't move up very quickly, it starts to grind up after a larger move. So if you want to look at moving support, so to speak, you want to identify the range from May 28th. This is probably the next best level. We're not going to do this for you right now, but just to give you an idea, it looks like this. Something around this area here or even here is probably your better bet, so to speak, to find support. We still like this level here between 1888 and 1901. However, 1909 to 1914 can provide some support. As you can see, there's a brief consolidation period before the market took off again. So that is what you want to look out first. If you are long stock and you got long stock recently or from the recent breakout back on May 22nd, we'll call it, this is the level where you might want to start trimming out of positions or looking for positions to add to if the S&P comes down into this level and holds and continues upwards, because we are seeing a normalization, so to speak, of the market. However, we still haven't gotten or seen an actual pivot from the market, and we've talked about it for 2 weeks now. That would be the most ideal condition before getting back in or adding to positions to the market, because you just don't know how far this thing is going to run. Eventually, it does have to pivot. You just have to keep moving your levels upwards if it continues to move, so that you can actually time it. So, however, that's not a green light to say, oh, just buy stock because it's going to go up. You have to understand there's no point of buying stock if price is going to come down to this level, or it's actually going to come down into this level before it moves back up. And you can sit there and say, well, it'll come back. Yeah, but you got to be a moron to sit there and buy stock, allowing yourself to lose money before you make money. I mean, no one thinks like that unless it's the stock market. People lose their friggin' minds when it comes to trading in the stocks or the stock market. They're just in a rush to make money, and anyone who's in a rush to make it is going to lose it faster than they're going to make it. So, and they're not understanding how the markets are working, and that's the point of Wealthy Bucket, is to understand that. So that's probably where you want to move your level to. Now let's take a look at the other indicator, which is the Japanese yen, and you can see the market really took off once the yen on Monday just crashed through. It barreled through our immediate support that we had identified. Recall in our analysis on Sunday, we wanted to move it higher to catch it faster. If it wasn't going to hold, it was going to come down faster. Had we kept the level where it was, it would have been down here, and we would have mistimed or ill-timed a larger move. I mean, granted, it did happen all in one day. However, you want confirmations to happen faster, so to speak, and that was the point of us moving our immediate support levels up to this 98.01 to 98.22 level, and it was the right call. Prices come down. Now we're looking at this 97.14 as the next stop for the yen. We could be looking at this level here. However, we can see a breakdown, and then we're going to hold firm at this level and see where it goes from there. Understand that while this is moving up overnight, if the yen continues to move higher, we're going to get a bit of a pullback in the S&P 500, and that's okay. You just want to figure out now, or let the market figure out, or figure it out for you. Is it going to come into this level here? And if it does it hold? If it holds, perfect. Then you know you can add more to that, or add more to your position, because our target now for after the S&P traded through 1919, our target for the S&P is now 1961. So there's a pretty decent move going upwards that'll allow you to add to your current positions, or if you somehow missed the most recent run, which is fine, it gives you an opportunity to add to that position based on your market timing skills, because you're actually catching the pivot in a market, which is an ideal situation so that you at least get the direction right. I mean, we say it in all of our seminars and webinars. I mean, you could be a bad stock picker. You could be a horrible stock picker. However, if you can get the direction of the market right, if you can correlate the markets properly, and you can get the three directions consistent, and the three directions are going to be it's up, it's down, and it's sideways. If you can catch these directions consistently on a consistent basis and understand where the market's going to continue or it's going to break down, you could be a horrible stock picker and still make money. That's the truth. So your takeaway is, now the yen looks like it's going to retrace upwards. If it's going to retrace upwards, this is the level that you're looking at in terms of where the next intermediate or immediate immediate pivot point is going to be. We're not going to revise it up yet. We want to see how this is going to hold, but we're giving this to you now so that this is not going to be, we're not going to give it to you on Friday or Monday after the fact. There's no point of being an after the fact forecasting company and education company. Anybody can tell you after the fact that, oh, that was support there and that's when it pivoted. Yeah, sure, I mean, anyone can do that. Any moron and monkey can do that. However, show me someone who can forecast the market accurately and consistently over a period of time, and who's not talking from the cheap seat, so to speak, and you got my ear. Anyone else who can tell me after the fact or who's writing post-market commentary, you can remain in the cheap seats. It doesn't work for me, and it shouldn't work for you, because any moron can do it. So that's your takeaway. Watch out for this level. Yen's coming back up right now as we speak. Now, how far will it go? That's really what we want to focus in on, and this is the next level we want to focus in on for yen. Will it trade back through here? If it does close above here, then we're going to get a larger pullback in the equity markets. That we're actually going to get that pullback that we want down into that 1903, 1906, 1901 level, down to 1888. That's what we want, because we're going to get a chance to buy equities at even a further discount as they look to move higher. If you have any questions, email us at service@wealthybucket.com. If you don't have any questions, then send us a smile or whatever it may be. We hope you've been having a great week, and we thank you for stopping by the Wealthy Bucket.